You know, it's kind of wild how often you see people who are super smart, like academically brilliant, making some pretty head-scratching money decisions.
It really makes you wonder, doesn't it? You'd think a high IQ would equal automatic financial success. But then you see folks with no fancy degrees or Wall Street experience building up impressive wealth.
It's almost like there's this hidden element that plays a bigger role than just, being good at math or understanding the stock market.
Yeah, and that's exactly what we're going to dig into today. We're going to unpack some really interesting ideas from Morgan Housel's The Psychology of Money.
It's a book that really digs deep into the human side of money, the often overlooked forces that shape our financial lives.
Because honestly, it's not just about crunching numbers or memorizing formulas. Our psychology, how we think and feel about money, has a huge impact.
So consider this your crash course in the psychology of money, whether you've read the book or this is your first intro to these concepts.
We're going to explore the key takeaways that can help you, the listener, make better financial decisions no matter where you are in your journey.
And to really illustrate this point, Housel opens the book with two contrasting stories that are just, well, kind of mind-blowing.
First, you've got Ronald Reed, a humble janitor and gas station attendant who lived a very frugal life, nothing flashy.
You wouldn't look at him and think, multimillionaire.
Nope, not at all. But when he passed away, guess what? He left behind millions, a fortune donated to charity.
It's incredible, right? And then on the other side of the spectrum, you have Richard Fuscone. This guy was the picture of success. Harvard grad, high-flying executive at Merrill Lynch.
Retired young, became a philanthropist. The classic made it story.
Exactly. He was praised for his business savvy, his judgment, his integrity. Like, he had it all.
And yet, despite all that background, all that experience, Richard Fuscone ended up losing it all. His properties were foreclosed on, sold for a fraction of their value.
It's almost like a Greek tragedy.
Yes.
So what went wrong?
Well, the book argues that the real difference wasn't their intelligence or education, but their behavior, their soft skills when it came to money.
Soft skills. So it's not just about knowing the right financial moves, but actually having the discipline and mindset to follow through.
Exactly. Because knowing the best investment strategy in the world won't help if you can't control your emotions when the market dips, or if you lack the patience to stick with a plan for the long term.
So Ronald Reed, despite his humble profession, clearly had those soft skills in spades. He was patient, consistent, frugal.
Absolutely. And Richard Fuscone, despite his impressive credentials, well, maybe he let overconfidence or perhaps other factors get in the way of those crucial behavioral aspects of financial success.
So we're talking about psychology, not just technical knowledge.
Right. And one of the first things Housel emphasizes is how much our personal experiences with money, our unique history, shape the way we view it.
I mean, it makes sense, right? Someone who grew up during a period of hyperinflation is going to have a totally different gut reaction to rising prices than someone who's only known stable economic times.
Absolutely. The book shares this anecdote about JFK. When asked about his memories of the Great Depression, his recollections were surprisingly vague.
And it's a reminder that even within the same historical event, our personal experiences can be so different, and those experiences color how we see the world, including the world of money.
Research even suggests that an individual investor's willingness to take risks is more influenced by their personal history with investments than their education level.
So our financial worldview is practically baked in early on, based on the circumstances we were born into and the economic climate we experienced.
To a large extent, yes. It's like Bill Gross, the famous bond investor, admitted that his career success was partly due to the decades-long decline in interest rates that coincided with his time in the market.
He was in the right place at the right time, with the right skills, but also the right historical context.
Exactly. And for someone who came of age during a time of soaring inflation, bonds might seem like a terrible investment, even if the numbers currently look good.
It really shows how personal experience trumps textbook knowledge when it comes to our financial gut reactions. And the book has even more concrete examples of this.
Oh, definitely. Like the vastly different unemployment rates experienced by different groups during the 2009 recession. Those varying economic realities shape how people view opportunity, security, even risk.
It's not just abstract economic theory. It's real life playing out in different ways for different people.
And the book tells this powerful story about a factory worker in China. For many in the West, working in a sweatshop might seem like the worst-case scenario.
But for her, it was a step up, an improvement over her previous life.
And it highlights how our financial decisions make sense to us in the moment based on our own internal model of how the world works, even if they seem strange to outsiders.
Which brings us to something that, on the surface, seems to defy logic: the appeal of the lottery, especially among lower-income folks.
Yeah, statistically, it makes no sense. Lower-income households often spend a bigger chunk of their income on lottery tickets than those who are better off.
And it's the same group that often struggles to cover unexpected expenses. So why do they do it?
The book offers an interesting interpretation. For people struggling to make ends meet, the lottery can be the only tangible way to dream of a better life.
It's not really about the odds of winning, but about buying into a possibility, a hope for a future that feels otherwise unreachable.
Exactly. And it speaks to the power of our hopes and dreams in shaping our financial decisions, even when those decisions might not be statistically sound.
Speaking of shaping outcomes, the book then dives into the often overlooked roles of luck and risk in our financial lives.
These are forces that are always at play, whether we acknowledge them or not.
It's easy to focus on individual effort and skill, but the reality is that external factors, things beyond our control, have a huge impact.
There's this great quote from Scott Galloway: "Nothing is as good or as bad as it seems."
It's a good reminder not to get too caught up in the hype, whether it's positive or negative.
And to illustrate the influence of luck, the book tells the story of Bill Gates and his extraordinary access to one of the world's few computers in high school.
The odds of that happening, the perfect storm of events that led to it, it's mind-boggling.
And then you have the flip side, the risk. The book talks about Kent Evans, Bill Gates' brilliant friend who could have been a Microsoft co-founder.
But tragically, he died in a mountaineering accident, a completely unpredictable event that changed everything.
It's a reminder that even the most promising paths can be derailed by forces outside our control.
So for every success story, there might be a story of unrealized potential, all because of luck or misfortune.
And even Robert Shiller, a Nobel Prize winner in economics, has said he wants to understand the exact role of luck in successful outcomes.
But acknowledging luck is hard, right? It's almost like admitting weakness.
Exactly. When we see someone else succeed, we're tempted to downplay luck and focus on their effort.
And when we succeed, we don't want to take away from our own hard work by saying it was just luck.
It's a human bias. And the book points out that we often judge others' failures as bad decisions while blaming our own on bad luck.
So separating skill from luck when analyzing financial outcomes is tricky, especially when looking at extreme cases.
The book mentions Rockefeller and Vanderbilt. Were they just incredibly skilled, or did they also benefit from the right circumstances?
And even Benjamin Graham, the father of value investing, admitted a big chunk of his success came from a lucky break with Geico, an investment that actually went against his own rules.
It shows that trying to draw neat lessons from the outliers can be misleading. We might learn more from studying the average person's financial life.
As Bill Gates said, success is a lousy teacher. It can make us overconfident and blind to the role of luck.
Both success and failure can be misleading if we don't account for luck and risk. And that's why it's so important to build resilience into our financial lives.
Which brings us to the idea of enough, a concept that's so simple yet so profound.
The book has this anecdote about Kurt Vonnegut and Joseph Heller at a billionaire's party. The billionaire made more in a day than Heller's book Catch-22 made in its lifetime.
And Heller's response is amazing. He says, yes, but I have something he will never have. Enough.
It's about contentment, realizing that more money doesn't always equal more happiness.
And the book contrasts this with Rajat Gupta, the McKinsey CEO, who had immense wealth and status, but risked it all for even more through insider trading.
He ended up losing his freedom, his reputation, a big chunk of his money, a classic case of greed leading to downfall.
As Warren Buffett put it, risking what you have and need for what you don't have and don't need is plain foolish.
It's a lesson many of us could stand to learn. Knowing when you have enough can protect you from unnecessary risks.
Now, shifting gears a bit, let's talk about something that works quietly but powerfully over time: compounding.
The magic of compound growth. Small, consistent actions can lead to huge results over the long haul.
It's like the book's analogy of ice ages forming from slightly cooler summers. A small change over time creates a massive effect.
Exactly. And financially, it means that small, consistent savings and investments, given enough time, can grow exponentially.
It's counterintuitive because we tend to think linearly. But the math of compounding is just on another level.
Think about adding $100 to your savings every year versus earning a steady percentage return on a growing balance. The difference over decades is staggering.
Even Bill Gates famously underestimated the power of compounding when predicting Gmail's storage needs.
It just shows that even the smartest among us can miss the potential of exponential growth.
So time and consistency are key for compounding to work its magic.
But there's another crucial element: survival. You have to stay in the game long enough to reap the rewards of compounding.
And the book highlights this with two contrasting outcomes from the 1929 crash. Jesse Livermore, who made a fortune, and Abraham Germansky, who lost everything.
Michael Moritz of Sequoia Capital summed it up perfectly. I think we've always been afraid of going out of business. That fear of failure, that focus on survival, is what allows you to stay in the game long enough to let compounding work.
So it's not just about chasing high returns, but also about avoiding those catastrophic losses that can wipe you out.
Compounding needs years of consistent growth. You can't compound if you're constantly starting over from zero.
Like holding cash during a bear market. It might seem like you're missing out in the short term, but it can prevent you from being forced to sell at the worst possible time.
And those forced sales can absolutely devastate your long-term returns. It's about playing the long game, not just winning the next hand.
Which brings us to another crucial concept: room for error, or what's often called a margin of safety.
This is about acknowledging that we can't predict the future perfectly and building in buffers to protect ourselves from the unexpected.
I mean, think about the past couple of decades. 9/11, the financial crisis, the pandemic. No one saw those coming with perfect clarity.
Exactly. A good financial plan isn't just about optimizing for the best case scenario. It's about preparing for the worst case scenario as well.
So it's not about being pessimistic, but about being realistic and building in resilience.
Right. Whether it's a frugal budget, a flexible mindset, or a longer timeline for your goals, having room for error increases your chances of success.
It's about acknowledging that you're going to make mistakes, that unexpected things will happen, and having the resources to weather those storms.
And the book points out that throughout history, even during periods of stock market crashes and high inflation, the overall trend has been towards improving living standards.
You need that short-term paranoia to survive the volatility, but also that long-term optimism to ride the wave of progress.
And it's okay to be wrong sometimes. Even the best investors get things wrong. The key is not to overreact to individual mistakes.
Like Walt Disney, right? He had early business failures, but he kept going, and look what he achieved.
And the book talks about tail events, those rare, high-impact occurrences that drive a disproportionate share of results.
It's like a small number of venture capital investments generating most of a fund's returns, or a handful of companies driving the majority of the stock market's gains.
Exactly. Most investments might be mediocre, but a few big wins can make all the difference. The story of Carolco, the film studio that went bankrupt despite apparent success, shows how common this is.
So it's about surviving the inevitable bumps in the road so you're still around when those big wins happen.
And that's where room for error is crucial. It gives you the staying power to ride out the volatility and benefit from the long-term trends.
Now let's talk about something that many people consider the ultimate form of wealth: independence.
Ah, yes. The freedom to control your own time, to do what you want when you want, without being beholden to a job or financial constraints.
It's not just about the amount of money, but about what that money allows you to do.
The book argues that people seek wealth because they believe it will bring happiness. And the common denominator happiness is a sense of control over your own life.
There's research showing that a strong sense of control is a better predictor of well-being than income or job status.
It highlights the intrinsic value of money, its ability to buy you time and options. The host even shares a personal story about leaving a potentially lucrative but time-consuming internship to pursue his passion for music.
It was a trade-off, but it was about gaining control over my time, doing something I loved, even if it meant less money in the short term.
And it's interesting that the U.S., despite its wealth, has higher levels of worry and stress than the global average.
Maybe it's because our work culture often feels like we're always on, constantly plugged in, with less control over our time.
It's like Rockefeller, who emphasized quiet contemplation and strategic thinking. He understood that his most valuable asset was his mind, not his physical labor.
And in today's world, where so many jobs are mentally demanding, that sense of being always on can be incredibly draining and erode our sense of control.
Which makes that pursuit of independence, of reclaiming control over your time, even more valuable.
Now, the book also touches on something that can be a trap on the path to genuine wealth: the allure of conspicuous consumption.
Ah, yes. The tendency to equate spending with wealth. The desire to show off, to impress others with material possessions.
The host shares an anecdote about working as a valet, noticing that people admired the expensive cars more than the drivers.
And often those driving the fancy cars weren't even that wealthy. They were just putting on a show.
It's a reminder that people often seek wealth to gain admiration. But true respect comes from character, not possessions.
And the book introduces this great concept: wealth is what you don't see. It's the unspent assets, the savings, the investments, the things working behind the scenes.
It's easier to imitate richness, spending, than true wealth, saving and investing wisely.
Think of Ronald Reed again. His wealth was hidden until he passed away because he wasn't focused on outward displays.
Which brings us to another fundamental principle: saving. The book makes a strong case that your savings rate is more important than your income or investment returns when building wealth.
It's like the 1970s oil crisis, where energy efficiency played a big role in overcoming the shortage. Saving is like financial efficiency.
It's about focusing on what you can control. You can't control the market, but you can control how much you save.
And the value of wealth is relative to your needs. If you're content with less, your savings will go further.
A high savings rate isn't just about accumulating money. It's about having more options and needing less to feel secure.
And the book even links a high savings rate to caring less about what others think. When you're driven by your own goals, not keeping up with the Joneses, saving becomes easier.
You don't even need a specific reason to save. Saving itself creates options and a buffer against life's uncertainties.
It's about having the financial flexibility to pursue what truly matters to you.
Now, the book makes an interesting distinction between reasonable and rational financial decisions.
This is about acknowledging that sometimes pure logic isn't always practical or sustainable in the real world.
Like fighting a fever. It might be rational from a biological perspective to let it run its course, but it feels terrible, so we take medicine.
Exactly. And financially, sometimes a slightly less optimal approach, but one that you can actually stick with, is better than a perfectly rational strategy that you abandon after a week.
So it's about finding a balance between what makes sense on paper and what works for you emotionally and behaviorally.
The book gives examples like having a slight home bias in your investments or doing a bit of active trading for fun.
These might not be perfectly rational, but they can be reasonable if they help you stay engaged and committed to your overall plan.
Like Jack Bogle, the founder of Vanguard, who invested in his son's higher fee funds, even though it wasn't the most financially efficient move.
It was a reasonable decision based on family and personal values,
Right.
even if not strictly rational.
And now let's talk about a common trap when trying to learn from the past: historical determinism.
This is the idea that we can use past data to predict the future with certainty, especially in finance.
But the book cautions against relying too heavily on history as a crystal ball.
Unlike fields like geology or medicine, where basic principles remain fairly constant, economics and finance are always evolving.
Human behavior changes, technology disrupts things, global structures shift. It's a constantly moving target.
The book describes Mr. Market as wearing a capitalism at work t-shirt and wielding a sledgehammer.
A vivid image. And just think about the unpredictable events of the past century. World wars, technological revolutions, 9/11.
No one could have predicted those with perfect accuracy based on past trends.
And the book even shows how seemingly unrelated events can have cascading consequences.
Like 9/11 leading to interest rate cuts that contributed to the housing bubble and ultimately the student loan crisis. It's all interconnected.
As Daniel Kahneman said, the lesson from surprises is that the world is surprising, not that we should use past surprises to predict future ones.
So while history can offer valuable insights, it's not a foolproof guide. The future is always going to throw curveballs.
And the book points out that even Benjamin Graham's classic investment formulas are less effective today because of increased competition, technology, and economic shifts.
So the best we can do is learn from the past, but remain flexible and adaptable in the face of constant change.
Which brings us back to that crucial concept of room for error. Because in a world of uncertainty, having a buffer is essential.
The book uses the example of blackjack card counting. Even when the odds are in their favor, skilled counters don't bet everything on a single hand.
They understand that unexpected things can happen, even when the probabilities are on their side.
That margin of safety allows them to survive those inevitable losses and stay in the game long enough to win in the long run.
Like Bill Gates always keeping enough cash to cover a year's worth of payroll, or Warren Buffett's massive cash reserves.
It's about ensuring survival, even when things don't go as planned.
And that brings us to another psychological bias that can trip us up: The allure of pessimism.
It's almost like pessimism has more credibility. Sounds smarter somehow.
It does, doesn't it? But the book defines true optimism as believing the odds of a good outcome are in your favor over time, even with setbacks.
It's not about being naive. It's about having a reasoned belief in progress and the ability to overcome challenges.
The book contrasts this with extreme pessimism, like that Russian professor who predicted the collapse of the U.S. in 2008.
It seems like those doomsday predictions often get more attention than equally extreme optimistic ones.
And history shows us that things rarely play out as badly as the pessimists predict.
Like Japan after World War II. They were devastated, but came back stronger than ever.
Hans Rosling talked about this, how people often have a distorted view of the world, thinking it's worse than it actually is.
John Stuart Mill even said that those who despair when others hope are often admired as wise.
Financial pessimism is especially common because money matters to everyone, bad news sells, and the stock market is constantly in the spotlight.
Even in 1929, when few people owned stocks, the crash captivated public attention.
The book argues that pessimism often relies on linear extrapolations, assuming bad trends will continue indefinitely.
But it ignores human ingenuity and the ability to adapt and innovate, like oil production exceeding pessimistic forecasts because of fracking.
Problems often create the incentives to find solutions.
Think of the Wright brothers. Their invention was initially met with skepticism, even ridicule.
And pessimism is easier to narrate because negative events are often more vivid and memorable.
Optimistic narratives require a longer view, looking beyond the immediate challenges.
Like the dramatic decline in heart disease deaths over the past 50 years, a huge positive development that gets less attention than sudden crises.
So while acknowledging risks is important, we should be wary of letting pessimism cloud our judgment.
Absolutely. And finally, the book emphasizes the power of stories in shaping our financial realities.
The stories we tell ourselves, the narratives we believe, can have a bigger impact than we realize.
The more we want something to be true, the more likely we are to believe a story that supports that belief, even if it's unrealistic.
Like that centenarian who, after World War I, naively believed there would be no more wars. He wanted it to be true, so he clung to that belief.
These appealing fictions are especially potent when we face high stakes and limited control.
The book's example of the Yemeni father and the burning stick is a tragic illustration of how desperation can lead to believing anything.
And this applies to finance. People listen to bad investment advice because the potential reward of being right is so alluring.
Like actively managed funds. Most underperform, yet people keep investing because of the story of finding that market-beating manager.
And Bernie Madoff's Ponzi scheme thrived because people wanted to believe the story of consistently high returns, even when it was too good to be true.
Our own internal narratives, often formed early on, shape how we interpret the financial world.
Even when we know forecasts are often wrong, we crave them for a sense of control in an uncertain world.
So as we wrap up this deep dive into the psychology of money, what are some key takeaways for our listeners?
Well, the specific applications will vary, but there are some universal truths. Be humble in success, forgive yourself in failure, recognizing the roles of luck and risk.
Accept that things will go wrong, and focus on the big picture, not just individual wins or losses. Use your money to gain control over your time, as that's a key to happiness.
Be kind, not flashy. Seek respect through character, not possessions. Save consistently, even without a specific goal, as a buffer against the unexpected.
Understand and be prepared to pay the non-monetary price of success, like volatility and uncertainty. Build in a margin of safety to protect yourself from the unknown.
Avoid extreme decisions driven by current market conditions or fleeting emotions. Your goals will change, so be flexible.
I've personally found that even as my income has increased, keeping my lifestyle relatively consistent had allowed me to save more and gain more financial freedom.
It's about aligning your spending with your values, not trying to keep up with some external standard of success.
And another key takeaway, never unnecessarily interrupt compounding. Charlie Munger said that, and it's so true. Time is your greatest ally when it comes to building wealth.
It's amazing to think about how much the world has changed, especially economically, since World War II. The rise of consumerism, the globalization of markets, the speed of technological change.
It's a reminder that we're all part of a larger story, a constantly evolving narrative that shapes our financial lives.
So as you go about your day, think about the stories you're telling yourself about money. Are they based on solid principles, or are you clinging to appealing fictions? Are you letting your past experiences unduly influence your present decisions?
It's a journey of self-awareness, of understanding the often hidden forces that shape our relationship with money.
And by becoming more aware of those forces, we can make more informed, more conscious choices that lead to genuine financial well-being.
Thanks for joining us on this deep dive. And remember, the psychology of money is just as important as the numbers themselves.
Keep learning, keep questioning, and keep striving to make your money work for you, not the other way around.